San Francisco State University, Finance 372, Take 5, Prologis, and Action.
Good evening, class. Today we're going to be going over Prologis. My name is Simon.
I'm H.E.
My name is Trevor.
And we're going to be going over some recommendations on buy, sell, or hold. And from our calculations, we got an intrinsic value of $50 from a current price of $54.69 with a discount rate of 9%. Tonight we'll go over the background, the company overview, the finite conditions of the company, and different methods, evaluations. Prologis is currently traded on the New York Stock Exchange with the ticker symbol of PLD, and it was founded in 1983 from MAH00761, and their corporation is in Fisherman's Wharf in San Francisco. And here's the current leadership. I'm going over the SWOT analysis. Currently, they're a powerful geographic position in Asia, Canada, and United Kingdom. Currently, they're the global leader in providing industrial warehouse and facilities. Some of their weaknesses are that they're pretty big and they own about 50% of the market share. And some of their opportunities are they can probably expand into the different areas of the world, maybe South America or Australia. And the threats are probably the current president, maybe Donald Trump administration with the international trade barriers, and so maybe increased tariffs, import and export restrictions on raw materials. The products and services, they currently have 3,000 properties and distribution centers, facilities, about 678 million square feet. They've got 1,600 employees in 20 countries that collaborate with customers and achieve operational efficiency. They work with companies such as Amazon, FedEx, Walmart, and Home Depot to provide logistic real estate solutions to ensure efficiency delivery for products worldwide.
Yep. And I'll be talking about the industry's overview. We took the top 5 REITs. We have them right here: Prologis, Duke, Liberty, DCT, First International Realty Trust Incorporated. We took their market cap, which is in billions. We added them all up to get a total, and then we took their market cap and divided to get their market share. You can see here that Prologis owns 54% of the market share in the top 5, which really shows how much money and power they have in the industry. Next, I'll be going over the financial conditions. We first compared the equity ratios, which was the price earnings, dividend, and the dividend yield, and the growth rates for the past 3 years, which we use revenue over operating income and EPS net growth, or earnings per share net growth. As you can see here, the financial overall condition is average. Their price equity is below average compared to the industries. Their dividend yield is basically the same as the industries. Their growth rate in revenue is 13.1%, and the industry average is 14.7%, so it's about average. Operating income is 30 versus 49, so it's below average. And EPS net growth is 79 versus the industry average of 59.2, which is above average. Overall average. The next financial conditions we decided to compare were the profitability in percentage and leverage ratios. We use net profit margin, ROA, ROE, debt to equity, and interest coverage. Overall, Prologis is average in these categories. The only one they especially excelled in was the net profit margin, which was 50.5% compared to the industry average of 27.8%, almost double, so we gave it a good condition, maybe even excellent maybe. Their ROA and ROE are both below average compared to the industries. Their debt to equity ratio is a 0.7 versus the industry 0.9, which is below average, and the interest coverage is a 2.9 versus the industry average of 5.4. We gave it an above average only because their peers were also very low, and you can see that with Duke being 1.2. So next, the technical analysis. For the technical analysis, we looked at the stock price over the last 2 years. We have the support line, the resistance lines, and the trend line. I'd like to first go over the support line. It's the bottom part, around $45. It's a support line because the stock price over the last around 8 months, 10 months, it doesn't go below $45, so we know that that's the support line. The resistance line is at around $56. It's on the top in green. You can tell that one is the resistance line because the stock price doesn't ever go above it. The bit kind of bounces off of it at the top part. And the trend line is the lowest price in the last 2 years to the price it is now. So it's from $36 to $54. Using this trend line analysis, we can see that our assumption is that the target price will be around $56, and that is greater than the current price with a premium of 2.4%. Next we have the valuations. This is the first one, the perpetuity model. We used Fidelity to get the risk-free rate, which is the 10-year average. So we had the risk-free rate. We used the beta of 0.9. We had the expected market return of 8%, since it was somewhere between 8 to 10%. We want to be conservative and say 8. So using that, we figured out the CAPM. The FFO we got off REITwatch, 2.66. The estimates are above right there. The growth rate's right there. And we used the 7%, which was the CAPM, to figure out the REIT value. Our intrinsic value using the perpetuity model is a $40.40, which is below the current price at a discount rate of 26%. Next, we have the Gordon growth model. Similar as the last slide. We use the CAPM model, same numbers there. The only difference is for the Gordon growth model, we divide the FFO per share by rates minus growth. And for this one, we use the same 7% as the rate because we thought CAPM was the safest route. And then we decided to go with a 2% growth rate rather than a 3 or 1% because after doing the calculations, 3% seemed really, really ambitious, and the 1% seemed a little bit too weak for a strong REIT such as Prologis. So we took the 2%, and we ended up with $56.6 as our intrinsic value for our Gordon growth model, which is a little bit above the current price with a premium of 4%.
So I'll be going over the multiples approach. So we got these peer group FFO multiples from REITwatch. So for Prologis, for 2016, it was 19 times. For 2017, it's 20 times. And for 2018, we used 19 times. So we used 19 times is because we don't believe that the stock price will go up significantly compared to the estimated FFO. So we used it and multiplied it by the FFO of 2018 estimate to give us a intrinsic value of $53.80, which is below the current price, which is $54.69 with a discount rate of 2%. So for the discounted cash flow, we have a weighted debt of 41%, weighted equity of 59%. We got this information from Google Finance. Our return on debt is 4.5%, because we wanted to be conservative. For return on equity, we got 7%, which is our WACC. Which is our CAPM, and through calculations, we got our weighted average cost of capital of 6%. So for our FFOs, for 2018 we had $2.83. For 2019 we have $3. For 2020 we have $3.15. For 2021 we have $3.28, and 2022 we have $3.37 with a terminal value of $48. And adding all that, and through calculations, we have an intrinsic value of $47.10, which is a significant discount, significant lower price than the current price, which is $54.69, which gives us a discount rate of 12%. So for our net asset value valuation, our net operating income is $670 million with shares outstanding of 530 million. So by calculating that, we got a net operating income per share of $1.26, and multiplying our capitalization rate of 3%, which gives a net asset value of $42. So as we look through the weights, we figured out that DCF and our multiple will have the highest accuracy. So we chose that, which will give us an intrinsic value of $50, and we recommend a sell with an intrinsic value of $50. With a discount rate of 9%. So our total trades is 12. So for our stock we sell short, write calls, buy puts. For ETF we sell short, write calls, buy puts, and for indices we write forwards, write futures, write calls on futures, and buy puts on futures. And thank you.